Hi everyone, Woody here for the latest Fat Tail Daily podcast. Now, 5 years ago, the world changed pretty dramatically with the outbreak of COVID-19, and the financial repercussions of that period are still echoing through the markets today. My guest today, Brian Chu's latest piece, draws on some fascinating parallels between the monetary response to the pandemic and today's gold market dynamics, suggesting that we might be at the start of something big rather than at the end. Now, what really caught my attention was how Brian connected the dots between government deficits, currency movements, and gold's performance, particularly his observation that gold has delivered positive gains in Australian dollars every year since 2020, despite the rate hiking cycle. So, Brian, welcome, buddy.
Hey Woody, how's everything going?
Uh, yeah, good, thanks. Let's start with something intriguing
Hmm.
from your piece today, and this is the idea that the real gold cycle is just getting started despite the significant gains that we've already seen. What makes you think that we're still in these early stages of gold's bull run?
Okay, so if you look at the price of gold, it's quoted in US dollar terms, and as we're aware, the US dollar, and also the global currencies around in the last 5 years, they've been creating a huge amount. I think, to my understanding, the amount of currencies created in the US, especially in the last 4 years, is almost the equivalent, if not more than, all the currencies in the US created since the nation began back in the late 1700s. So we've seen the massive tsunami of liquidity. It was supposed to go to boost businesses, to save the economy from imploding. What we saw instead was all these policies which came out from the green agenda, from Build Back Better, also worldwide in paying small businesses and households to stay at home while certain large businesses were able to continue to operate. That created inflation. We saw there was a massive gap in productivity. So while you had huge amounts of funds flowing into the economy, the where they were spent on, what types of things were happening. We were also trying to create higher cost energy in order to steer the world into electrification and decarbonization, which thankfully, with the with President Trump and his administration coming back, they're rolling that away and bringing back in fossil fuels and more common sense energy
Mm.
policies. But we've squeezed a huge amount of toothpaste out of the tube. You can't really put it back in. So that those funds are still going to have to find a home. It needs to find a home in a productive area, and that's going to take a while. So in the meanwhile, I believe gold being an asset that offsets or um, is the antithesis of bad, dishonest money. I think that's going to benefit significantly, even though we've seen gold rise in Australian dollar terms by
Yeah.
about 80% in the last 5 years.
You've highlighted how gold and US dollar index, how the US dollar index typically move in opposite directions. Given the current state of US government finances, regardless of the new administration's new policies, how do you see this relationship playing out over the next few years?
So the two move here, the gold and the US dollar, they move in the opposite direction. And the US dollar index reflects a basket of currencies, major currencies that we measure the US dollar against. It you could say it's a de facto representation of the true value of the US dollar, because if the US dollar is worth more than, say, the six currency euro, the yen, the sterling pound, the Canadian dollar, Swedish krona, and the Swiss francs. That means the we're in a relatively strong fiat currency system, because because the US dollar is basically what a lot of people actually would like to hold um, as a safe haven currency. But when the US economy is weak, and also the fiat currency system is weak, then you see the price of gold go up because people want less US dollars, they want other assets instead. So, with the US economy at the moment, even though the Trump administration wants to improve the US economy, bring back manufacturing, spend on infrastructure to restore the nation's crumbling infrastructure. Just think about what happened to the the bridge at Baltimore,
Yeah.
the one which I think collapsed back in 2023.
Yeah.
You also look at what's happening with California and a lot of the major cities. Just think, in Australia, our public transport system isn't something we to write home about. But if you look at, say, Los Angeles and San Francisco, we're doing better than them. That really says something. These are the most developed nations in the world, and the public transport system is doing worse than some of the developing nations in Asia, Southeast Asia, and also the Middle East. So even though there is going to be a lot of work that we to do in the US, there's going to be potentially a log jam in Congress as the Democrats fight tooth and nail to stop the Trump administration from bringing these types of policies. And you can expect quite a few Republican moderates who do not like the Trump administration to also join forces with the Democrats. So
Mm.
these types of impasses, obstructions, will mean the intention is there, the right idea is there, but you are going to see significant deficits, and with deficits mean more borrowing, and that should benefit the price of gold. With manufacturing, the US can only bring back manufacturing if the US dollar is sufficiently competitive. And for that to happen, you need to bring the US dollar down. And we have seen the US dollar move down a notch from its highs 2, 3 weeks ago. And gold has benefited from this. Um, it's actually moved up to 2,770 US dollars an ounce, which is similar at similar levels as before the US 2024 elections.
Yeah, interesting. You also, the article that you've written today makes a distinction between trading gold's price movements versus capturing the rhythm of the gold market cycle. Can you elaborate on that a little bit, and specifically how investors should think about these different approaches?
Yes, so if you look at a cyclical asset, the way to invest in such assets is to ride the cycle. That's much more important than the ups and downs that you experience during the cycle. Now, in saying this, I I want to emphasize I am not saying there is no benefit from buying the ups and downs within a cycle. That's where a lot of people will make will profit. Technical and momentum traders, that's where they actually do quite well. A fundamental investor like myself who look for value and we ride the cycle in the down phases of the cycle, we will actually not do very well compared to those momentum traders who would buy the ups and downs within. But the immense returns, the ones that make millions and possibly billions for certain very successful investors, the ones who are in the mining investment legends, they ride that cycle and they will hold tight on some of their stocks even when they're going down in the bear part of the cycle. Some of us will sit on 70-80% losses, and where the momentum traders would say it's time to sell because the charts look particularly bad, the ones who make the serially successful gold and gold stock investors are actually adding to the holdings. So that's what makes a difference
Yeah.
for the really successful investors in gold and gold stocks against the ones who do well. It's riding the cycle and holding strong even during the ups and downs.
You mentioned that there are over 150 gold stocks to choose from on the ASX, but many could lose investors' money, right?
Yes.
What factors do you look at when evaluating gold companies in different phases of the cycle? Because
So,
there are many dodgy, not I don't want to say dodgy companies, but there are many companies that are just not going to do anything, right?
yep, that's right. So within these 150 to 170 gold stocks, there used to be, mind you, over 200 companies
Yeah.
about 2 or 3 years ago. And
That also tells you what part of the cycle we're in, right?
exactly, so there's actually been consolidation. There've also been several cases where gold companies just went just went bust. That was because of how brutal the last 4 years have been. And at the same time, the larger companies, the producers, have seen massive opportunities buying small mines and small companies, and even some of the larger companies combining at this time to, in doing so, they're able to pay lower prices to get good quality assets. So being able to understand the different types of producers, developers, and explorers, you would then be able to build a portfolio which would stand the test of time and and also not expose you to risks that you cannot stomach. So that's the first one: knowing the different types of companies and allocating your portfolio accordingly. Number two is looking at the individual companies and the assets that they have. So not all companies or not all mine assets are the same. You have the very developed mines that are producing gold. You have the deposits that are confirmed, and there are possibilities for them to actually start producing because they are commercially viable. They're profitable right now to develop. Then you have some deposits which are at the moment not yet um, worth developing because they're too early, or the ore quality is not at the stage where the current price justifies them. And then you've got the fertile greenfields land, which are still at the stage. There's just a lot of work to do. We still haven't seen any confirmed discoveries yet. So knowing all that, these assets, it would help you determine which ones you should allocate a bit more to, because there's there's more returns and upside potential than risk uh, associated with it. And then you've got also management,
Yeah.
geographical exposure, and the whole plethora of factors, which I would talk about in more depth in the coming weeks, because this video is the first one of a series that I would like to take people down a journey.
Okay, cool. Let's just loop back to the start very quickly for the final question.
Yeah.
You draw on some parallels between monetary response and to COVID
Hmm.
and today's environment. How do you see the current fiscal situation differing though from 2020, and what might that mean for gold investors?
So what's different now compared to what it was? Nowadays, we are in the rebuilding phase. Back then, it was in a phase where most people were actually, you could say, hoodwinked by the authorities. As we know now, much of the premise in which the world declared, the World Health Organization and governments around the world declared that a health crisis were made on bad science, not only bad science but fraudulent and questionable motives, which we're now watching. You can't fix, you can't go back to the past and redo it. What we now have to do is rebuild. So with the world rebuilding and with governments, with a different form of government coming in many Western countries, now they're bringing in more nationalist governments. They're bringing in governments that will not bow to woke policies, to experts merely by name, but not by their skills and knowledge. So so there should be better capital allocation going forward, but that's going to take time.
Yeah.
You would therefore, I'm looking towards development in commodities because of rebuilding. We're looking at improvements in technology, AI, but at the same time, resources are going to enjoy a significant uptrend simply because there's been so much under allocation and under investment in this field. With all that, why would gold also benefit? Because of the amount of currencies that are just flowing through the system, and the central banks are reducing interest rates to accommodate for what will hopefully be a renaissance in mankind towards a more common sense world and lower cost energy. And therefore, all of these would bode well for the rebuilding of a real functional economy.
Yeah. I wonder what that'll do to gold prices, but let's tackle that question and on another session. Thank you very much for your time, Brian. You've got actually a free gold report, which is anyone can access. I believe there'll be the details to how to download that straight after this video. And if you want to read Brian's piece today, please check out the link below. It's all up there on the Fat Tail Daily website, and it's all 100% free. Thank you, buddy.
Yep.
We'll talk very soon.
Thanks very much. And to everyone, God bless and happy Lunar New Year.